Now let's start section 15.2, which is talking about bank regulation. So regulation falls into a number of categories and what we're trying to do here. So basically the bank could have reserve requirements, capital requirements, or restrictions on the types of investments banks can make. We really want to provide stability for the banking system. So regulations require that banks maintain a minimum net worth, usually expressed as a percent of their assets to protect their depositors, and other creditors. Basically, what's happening here is the bank needs to have some money in the bank at all times. Okay, so basically, what's happening here is that we want to ensure that if you go to the bank to get your money, you have it there, like it's at the bank to where you can get it. The bank's not going to have all of their money out in the world to where if you go in there, they have zero money in the bank. That's not going to provide the stability for the economy, right? To where you are freaking out because you don't have your money. So we have these regulating offices, such as the Office of the Comptroller of the Currency and the National Credit Union Administration. We have these regulatory businesses or these government entities that are basically ensuring that the banks are following these rules. Okay? Because what we want to avoid is we want to avoid bank runs. So banking regulations is intended to maintain banks' solvency by avoiding excessive risk. So basically, solvency is just basically how much money they're able to give back to people. So we want to kind of solve that. So the bank run is when depositors race to the bank to withdraw their deposits for fear that otherwise they would be lost. So just how when we were talking about how demand is, you want to buy at the cheaper price, and at the cheaper prices today, you're going to demand more today. Well, imagine if there was news that there was going to be a war and that, the bank is going to be closed tomorrow. Okay, and it's like, whoa, hold on. If there's a war, I want my money with me. And if the bank is closed, how can I get my money? So I'm going to go to the bank today. And everybody starts going to the bank today. All right? And so this causes a bank run. Just like this picture here, we have all these people that are outside the bank waiting to get their money. Okay? And this is a problem. And the real issue here is because sometimes the bank doesn't have all of everybody's money ready to go at one time. Okay? So when there's a bank run, this causes a real problem for the bank because they don't have the money to give back to people. They have some, but not all of it. And if they have to give all their money away, then they're going to cause a big problem, and that's going to cause an even bigger issue, which we'll learn later on in this chapter. Okay, so we want to avoid bank runs. We want to make sure that we are financially stable. We want to have a lot of trust in our banks that our money is going to be there. So how can we protect against bank runs? To protect against bank runs, Congress has put in two strategies. Number one is deposit insurance, an insurance system that makes sure depositors in a bank do not lose their money, even if the bank goes bankrupt. Bankrupt is basically where you owe a lot of people money and you can't pay it back. Okay, so that's bankrupt. And so the deposit insurance is where basically if you had, let's say, $100,000 in the bank. Okay, and then the bank goes bankrupt. Bankrupt meaning they have $0. So here's the deal. You had $100,000, but now the bank has zero. So where did your money go, right? And that's going to cause a lot of problems because why would you invest your money or why would you put your money in a bank if it's going to be lost? Okay, so that's where deposit insurance comes in. That's where you're protected. You are protected up to $250,000 through the FDIC, the Federal Deposit Insurance Corporation. So as long as you have less than $250,000 in your checking account, that is federally insured. Banks pay an insurance premium to the FDIC to make sure that you are covered up to $250,000. If you had $1 million in the bank and the bank goes bankrupt, the government will only pay you $250,000. So if you were smart, okay, you would not put more into a bank than $250,000. You would have to move to different banks in order to make sure you hit the $250,000 mark. But that is the deposit insurance, only $250,000. Also, we also have the lender of last resort, an institution that provides short-term emergency loans in conditions of financial crisis. So basically, if the bank didn't have enough money, the government or the central bank could give you emergency loans in order to prevent you not being able to pay back somebody. So this is an emergency where, like, yeah, you do have to pay a loan, so you do have to pay an interest rate, but at least you can give the money back to the depositors or the consumers whenever they need it. Okay, so these two things are going to be protecting against bank runs. They're going to provide more stability for the economy. The big one is that FDIC. That's the one where if you go to the bank and you see a little sticker there that says FDIC approved, then you can confidently put your money in there, because you know if you put in $100,000 in the bank, and even if the bank did not exist anymore, you still can get your $100,000 back. In section 15.3, we're going to actually introduce what monetary policy is. I'll see you there.